Guys, I'm sorry, the last video unexpectedly stopped at this point. So let's talk about the buildings one more time. So when we are constructing a building, everything including architectural cost, building permit cost, contractor charges, payments for material, labor and miscellaneous cost, all will be included in the account name building. So if we are building our what we call apartment complex, all of those things will be included into the apartment complex. If we are purchasing an existing building, and suppose we are buying a uh, existing warehouse and trying to convert into a gym, for example, so that will include a purchase price and renovation of the building ready to be used. Means right now it's a warehouse, it's not a gym. So we have to make a lot of effort to convert into a gym. So when we are saying converting into the gym, I'm not talking about the weights, the free weights, the machines, all kinds of cardio machines. They are not part of it. When we are talking about renovating, means maybe we're talking about painting, we're talking about changing the door, windows, ventilation system. We are talking about putting a new floor. All of those things will be considered part of the building, ready for all the machines and weights and things to be put together to it. Machinery and equipment would always include the cost of the machine, the purchase price, the transportation and delivery charges, like we talked, insurance while in transit, and sales tax and other taxes that you may have to pay, including purchase commission, installation costs, and testing costs. So if you are buying a machine that is costing to you, say, purchase price $100,000, but you also have to pay all of those things, so by the time machine will start working for you in your business, it may cost you $170,000. So the machine on that day, say March 15, would be put on a balance sheet as a historical cost, not the price tag of 100,000, but including all the costs. All of these costs would be 170,000. Furniture and fixtures, desks, chairs, and file cabinets. They are also long-term assets, usually depreciate over 6-7 years. Cost of fixtures, anything that is attached to the floor, to the ceiling, to the walls, would be considered fixtures, and they also get depreciated. Now we're going to talk about our new topic, depreciation. A plant asset cost must be allocated to the period of the plant asset use. So what we are saying, an asset helps earn the future cash flow or the revenue for the business. So that means we are using that asset to make money. So that asset has been used. Once the asset is used, it's become an expense. So what we are saying, that this machine has a life of 10 years and I pay $100,000. I'm going to depreciate this machine over 10 years, a straight line method, for example. So every year I am going to say I have used $10,000 worth of this machine, because this $10,000 worth that we're talking about helped me make $1 million revenue, for example. So what we need to do is we need to know that how much expenses we have incurred in order to make that revenue. So the period of depreciation is the asset's useful life. So the 10-year that I was giving you is the useful life. And the company must also estimate the salvage value. Means if you are buying a machine and you estimate that this machine will last 10 years, you want to know how much this machine will be value after 10 years. So basically, when we are talking about depreciation, we know three things. We know the purchase cost or the historical cost. We know how much this machine, because we have all the paperwork, says 170,000. But we believe after the use of 10 years after using this machine may be 20,000. So how do we know that this machine would really, it's an estimate. You can ask the manufacturer of the machine, they can tell you. You can ask someone who is in the similar business using the same machine, they can tell you how long these machines are going to last. Or you can talk to CPA, or you can maybe look at the what we call depreciation tables. So these things, so these are estimates, and these estimate does not have to be accurate. The company must estimate the salvage which represent the asset and of its useful life. So that's the thing that we are going to. So three things that is important: the purchase price, the life that you are estimating is going to last that long, and what would be the salvage value. Is based on three main factors. Capitalized cost means during the use of the machine, if you have either spent enough money to increase the life of the machine or increase the capability of the machine or the capacity of the machine. So that will be a capitalized cost. So what does it mean? For example, you are driving a truck, you own that truck, and you take stuff from one point to another point. Now somebody told you that if you transport fruits and vegetables, you can make a lot of money. But currently your truck does not have refrigeration. So you install refrigeration in your truck. So now you have increased the capability of your truck. Once you increase the capability, the cost of installing the refrigeration on your truck will become the part, it would be a capitalized cost. So suppose you purchase that truck for $500,000, now you cost $100,000. So your truck book value will become, instead of 500,000, would be 600,000. And again, you can change the estimated life at any given time. After use of 4 years, you can say, hey, this machine doesn't look like going to be 10 years, this machine may last another 2 years. So that could be changed. Or you may say at the end of the life of this machine would be, say, $20,000 worth after 10 years. You say, now, no, I do not think this machine is going to last 10 years. And I think the salvage value of this machine will be 0. It's totally up to you. You can change those estimates. Always remember, estimates can be changed at the discretion of the business. Cost minus the residual value is called depreciable cost, or sometimes we call depreciable base. So keep that in mind. Three most commonly used depreciation methods are straight line, units of production, and double declining. A straight line, about 80% of the company use that. And the most accurate depreciation method is considered the unit of production. So unit of production is the most accurate method of calculating the depreciation. It's based on how much you have used. So for example, suppose you purchase an F-150 truck to use in your business. Now this F-150 truck has a life of 200,000 miles. You drove only 10,000 miles. So for example, you purchase that truck for $50,000. So for every mile you're going to ride, so you have 200,000. So the $50,000 truck you have, and you divide with 200,000 miles. So that means for every mile you're going to depreciate 25 cents. So for 10,000 miles, you're going to depreciate $2,500. So basically what you have used, you're going to depreciate. So that's why the unit of production method is the most accurate method. All right. Now we're going to do another thing. So depreciation expense is always reported on the income statement. So when we are talking about depreciation, we should also talk about accumulated depreciation. Accumulated depreciation is a contra asset account. Accumulated depreciation is a balance sheet account. So the asset account and the accumulated depreciation account, both accounts stay side by side on the balance sheet. So you're buying F-150 truck for $50,000. You have an account Ford truck for $150,000. First year you took the $2,500 worth of accumulated depreciation. So your accumulated depreciation will show it's a $2,500. And so the asset value minus the accumulated depreciation is called the book value or the net book value of the asset. So your asset at the end of the first year is not 50,000. The book value of the asset is 47,500. Okay. So here there is an example on this note. Assume you equipment costs 5,000 with a 3-year useful life and 500 salvage value. So annual depreciation would be 5,000 minus the 500 divided by the number of years. So you're going to take 1,500. So you're going to debit the depreciation expense. This information is going into the income statement, and then you credit the accumulated depreciation. This information is going into the balance sheet. So when you are purchasing this truck for $5,000, you're going to say debit equipment for $5,000, and suppose you pay cash, credit cash for $5,000. These both accounts are balance sheet account at this point, because you are just changing one asset with another asset. You giving up $5,000, you getting the $5,000 equipment. But at the end of the year, after the year, this is, you suppose you did on January 1st. This you are doing on at the end of December 31st. So on January 1st you bought, you just change one asset with another asset. But at the end of the year, you have this depreciation expenses going into the income statement. So on this balance sheet, you have the equipment for $5,000 and you have accumulated depreciation side by side for $1,500. Always have a credit balance. So your book value, as we talked about, is equal to equipment minus the accumulated depreciation. So 5,000 minus the 1,500 is 3,500. So the day you purchase, the book value was 5,000. After 1 year of use, your book value is now $3,500. Okay, I hope this makes sense to you. All right. The next thing we're going to talk about is basically the next method as unit of production. Before we go to unit of production, you notice that in a straight line method, your balance of the equipment always remain 5,000. First year, second year, third year. Annual depreciation expense is 1,500, 1,500, 1,500. So your total 4,500. Accumulated depreciation first year was 1,500, second year 1,500. So it's accumulating. So it's keeping track of it. So the second year is now 3,000. So the book value is now 2,000. Third year, your book value is asset is 5,000, but your accumulated depreciation is 45. So the book value is $500. All right. The next topic we're going to discuss is unit of production. The unit of production method allocates a varying amount of depreciation each year based on the usage. That is why it's considered the most accurate method of depreciation. When a plant asset usage varies by year, the unit of production method better matches the expenses with revenue. So that's it. The next thing, so we didn't do the what we call it the example. So let's do an example of let's do the example of the unit of production. So let's use the same thing. So we have example units of production. Okay. So first year you use suppose it's a Ford motor, so you drive or used for so first we have to estimate how many total hours we can use. So suppose the total hours this machine, the lifetime, this machine, this equipment can provide 50,000 hours of service. All right. So first year, this is providing you say 6,000 hours of service. Second year is providing you say 13,000 hours. Third year, it's providing you say 10,000 hours. Fourth year, it may provide you say 15,000. And the fifth year, 25, 28, 30, 4,000. So you have these. So how are we going to calculate the depreciation? So you paid $5,000. So $5,000 and you are using 50,000 hours. So 5,000 divided by $50,000. So we are talking about 5 over 50. So we're talking about 1 over 10 or 10 cents. Basically what we are saying that every hour this machine is going to work is going to depreciate at 10 cents. So we use 6,000 hours. So our depreciation expense for 6,000 multiplied by 10 cents. So that will be 600. So first year hour is 600. The second year it would be 1300. This one, it will be 1000. This will be 1500, and the fifth year it will be 400. So what is the total? 2500, 2900, 4200, 19, 29, 29, 39, 44, 4800. So we have a depreciation expense after 5 years. So that's how we calculate for the unit of production. Okay, I will make sure that I will post this video for you, this example with this video. Okay. The next method we're going to talk about is a double declining balance. It is usually considered an accelerated depreciation method. There are some assets that do not last very long. For example, computers, softwares. They don't last they have 2, 3, 4 years at best useful life. So we want to get the most amount of depreciation during the first couple of years. So that's how we do that. So the main accelerated is the double declining method, and double declining method balance multiplies an asset decreasing book value by a constant percentage that is twice the straight line depreciation. So assume the equipment cost again 5,000 with a 3-year useful life and a 500 salvage value. One more thing that we need to keep in mind: in the straight line method and in the unit of production method, we do not take the we do take the salvage value upfront, but we do not take the salvage value upfront in the double declining balance. So for example, we have the asset $5,000, obviously the beginning depreciation now, and we multiply, so we take the 66.7, so the first year annual depreciation is $3,334. Okay, and the same thing, and do it, and this percentage remains the same, and this percentage will give you this much. So the next year you only going to take the depreciation. So you notice that if you add these three depreciation, it will give you 4,500, because 500 is our salvage value. Reporting plant and equipment. Property, plant, and equipment are reported at book value on the balance sheet. We already discussed that. Companies may report as a single amount with the cost and the related accumulated depreciation disclosed in the notes. They do it, but it is not recommended. Disposal, when you are discarding so an assets wear out becomes obsolete, means it's obsolete in a sense that we think it is not productive to use in our operation. So discard the plan asset, sell the plan asset, exchange the plan asset for something else. Regardless of the type of disposal, there are three disposal: you are discarding it, selling it, or exchanging for better equipment. So bring the depreciation up to date, remove the old disposable depreciation, and record the value of the cash paid. So how we do that? So suppose we go back to the same example we did earlier on. Here we did this example, right? So we use this equipment, we purchased this equipment for $5,000, and now we are selling this equipment for $600. So how much cash is coming in? So we're going to say debit, cash is coming in $600. All right, very good. So what we are selling an equipment that we purchased for $5,000. So we're going to credit the equipment for $5,000. All right, when we remove the equipment, we also remove its accumulated depreciation. So its accumulated depreciation is going to be has a credit balance. So we're going to debit in order to cancel this, because we took 1,500 every year. So the total was 4,500. So we're going to debit 40 accumulated depreciation for 4,500. Now over here we have 600 plus 4,500, 5,100, and over here we have 5,000. So we're going to credit another thing, and it's called loss. Sorry, I'm sorry. We're going to credit another thing, is called gain, which is $100. So since you can notice that your salvage value was 500, you have depreciated up to 4,500. So the book value 5,000 minus the 5,000 minus the 4,500 is 500, and you are selling for $600. Therefore, you have a gain of $100 on the sale of this equipment. Intangible assets we talked about are patents, copyright, trademarks, other creative arts, accounting intangibles. Intangibles are amortized using a straight line method. They do not have salvage value. So for example, you purchase a patent for $10,000. So, and you going to use for life, you believe it's 5 years. So what you're going to do, you're going to calculate the amortization expense simply dividing the $10,000 by 5 years. So every year you're going to have $2,000 per year amortization expense. So when you purchase the patent, you basically did debit patent for $5,000 and you credit cash, for example, for $5,000. So this is on the date of purchase, right? At the end of the year on December 31st, you are saying debit amortization expense for $2,000, and you're going to credit. There is no accumulated amortization. You're going to credit the patent directly for $2,000. So when you have on your balance sheet a patent, so you purchase for $10,000, after 1 year you have reduced it for $2,000, so the book value is now $8,000. Okay, so this how we're going to do for this. Goodwill is the value paid above the net worth of the company's asset and liabilities. Suppose you have a company of asset $100, your liabilities are $50. So when you subtract asset minus liability, it should come as an equity. Equity is also called net asset, and this net asset in this case is 50. If somebody is offering for your business, say $200, hey, I will pay you $200. So the $200 above and beyond $50. So the difference would be called goodwill, and they are paying you for $150 for the goodwill. Okay, and the goodwill is not amortized. It get impaired, but this is not part of the this discussion, so we're not going to discuss that. Current ratio is current assets divided by total current assets divided by current liabilities. Debt ratio, we discussed this, divided by total liabilities by total assets. And trend analysis we discussed is an horizontal analysis that we talked about in chapter number 1. All right, so we ending our chapter number 2 here, and we will talk about chapter number 3 sometimes tomorrow.